If you want to understand the financial health of a country, do not begin with speeches, do not begin with slogans, do not begin with press conferences where polished people explain that everything is basically fine. The labor market is strong, inflation is under control, and the consumer remains resilient. Begin where pressure becomes behavior. Begin where people are forced to do things they never intended to do. A man can sit through a politician telling him the economy is strong and still quietly take money out of his retirement account to avoid eviction. A woman can hear that wages are rising and still return to work at 70 because groceries, insurance, and utilities no longer care what the headline says. That is where I would start. I have spent most of my life watching the difference between official language and lived arithmetic. The official language is always cleaner. It has to be. It is designed for confidence. Lived arithmetic is less polite. It shows up in credit card balances, missed payments, emergency withdrawals, second jobs, postponed doctor visits, and the tone of a household when the first of the month gets a little too close. That arithmetic is much more honest. And if I look at the American consumer through that lens, I do not see a golden age. I see a lot of people still standing, still buying groceries, still filling up the car, still making the mortgage or the rent, still sending the kids to school, still getting up and going to work, but doing it with less margin than the cheerful voices want to admit. Margin is what matters. It always has. The strongest financial lives are not the ones that look richest from the street. They are the ones with enough room that life can misbehave without turning into a crisis. A blown transmission, a medical bill, a reduction in hours, a child needing help, a parent getting sick, a tax surprise, a repair a month where 3 inconvenient things arrive in a row. If a household has margin, those things hurt, but they do not tear the structure apart. If a household has no margin, those ordinary intrusions become emergencies. That is why I pay such close attention when the emergency behavior begins spreading. The first signal that grabbed my attention in the material you gave me was simple and ugly. A record number of Americans are taking hardship withdrawals from their 401ks. And the reasons are not cosmetic reasons. The leading reasons include avoiding foreclosure or eviction, medical expenses, tuition, and home repairs. In other words, this is not mostly people using retirement money to chase luxury. It is people using tomorrow's stability to survive today. That matters enormously. People like to talk about retirement money as if it were some distant, abstract pile of digits sitting in a future that can defend itself. It cannot defend itself. Retirement capital is fragile in a particular way because its greatest power comes from time. Time is what turns ordinary contributions into something meaningful. Once people begin pulling money out early to survive, they do not only lose the withdrawn amount, they lose the years that amount would have had to work. That is the true damage a man who raids his 401k. To pay for a crisis is not just writing one painful check. He is selling future calm at a discount because the present became too expensive. I understand why people do it. This is not a moral lecture. A person facing eviction or serious medical pressure does what he must. But I do not take comfort from the necessity. I take warning from it. When retirement accounts become emergency checking accounts, the underlying structure is weaker than the headlines admit. This is the part the public often misses. The problem is not only that people need money. People always need money. The problem is where they are forced to find it. If the pressures become strong enough that workers are breaking open the long-term storehouse just to stabilize the current month, then the normal buffers have already been eaten through. That is not prosperity, that is late-stage improvisation. Then there is the second signal. Retirees going back to work, that one always gets dressed up politely. The public likes to say older people are working because they want to stay active, stay engaged, stay social, keep a sense of purpose. Some of that is true for some people. Fine, I do not deny it. But the material you gave me makes the deeper story plain enough. A record share of retirees are returning to work, and nearly half of them say the main reason is financial need and a weak economic outlook. A large share also say the cost of daily living is simply too high. That is not a hobby. That is arithmetic speaking through an older body. I have always found it remarkable how much society romanticizes labor when it is forced. A man of 70 taking a part-time job because he enjoys structure is one thing. A retiree returning because the numbers no longer work is another thing entirely. Those should not be mixed together just because it sounds nicer. There is nothing noble about discovering that the later years you spent decades financing still require wage income because the purchasing power of your savings, pension, or Social Security no longer buys what you thought it would. That is not a personal failing, it is a structural problem. And it reveals something that younger people often fail to appreciate until too late. A retirement plan can look reasonable for years and still fail once inflation. Debt service, healthcare costs, and housing expenses begin moving differently from the assumptions that were made when the plan felt safe. That is why I have never trusted neat retirement projections unless they also respect reality. Talent for changing the rules midstream. The old retiree who goes back to work is not only solving this month's problem, he is revealing that the whole sequence of assumptions behind his retirement may have been weaker than he was led to believe. Now move one level down into the ordinary monthly machinery of the household, and the story becomes even more uncomfortable. Consumer credit card debt has reached a record level. The number itself matters, but what matters even more is what sits under it. Large shares of users are carrying balances month to month, and the average interest rate is around 20%. 20% is not a convenience fee. It is not an inconvenience. It is a destroyer. I do not know many honest long-term investments that can reliably earn 20% after taxes and friction. That means the person rolling a credit card balance at those rates is not merely borrowing. He is moving uphill with a piano tied to his waist. I have never believed all debt is evil. A low fixed-rate mortgage is not the same animal as revolving consumer debt at 20%. A productive business loan is not the same thing as financing a television you should not have bought. Debt deserves classification, but high. Interest consumer debt belongs in the most dangerous category because it transforms ordinary life into a leak. Income comes in. Interest drains out, progress seems to happen, and then disappears. The person carrying that balance month after month starts feeling as though he works hard without getting traction. Of course he does. He is trying to run while the floor is moving the wrong way. What makes this especially revealing is that these balances are not sitting there in a vacuum. They are rising alongside other forms of strain. Credit card delinquency has risen sharply in a short period. Broader household delinquency has also moved higher. Student loan delinquency is even worse, with the material describing extreme deterioration and a huge borrower base. Now, in trouble, this is where the tone changes from anecdotal to systemic. One category in trouble can be explained away. One ugly number can be marketed around. But once delinquency begins rising across multiple categories at the same time, you are not looking at isolated sloppiness anymore. You are looking at pressure. And pressure, if it persists, changes behavior far beyond the debt markets themselves. The consumer gets more cautious or he gets more desperate. Sometimes both. He delays necessary purchases or he finances necessary purchases on worse terms. He stops investing. He raids retirement accounts. He returns to work. He misses payments. He accepts worse jobs. He drifts from planning into reacting. That is what debt strain does. It does not remain in the debt column. It infects the whole household. Student loans deserve special attention here because they reveal something almost cruel about the modern American promise. A young person is told that education is the route upward. Then he borrows heavily in the expectation that the future earning path will justify the present burden. Sometimes it does. Often it does not in the clean way advertised. Then the loan sits there for years, even decades, not merely as an expense, but as a claim on future flexibility. The material you provided makes the scale obvious. More than 40 million Americans are in student loan debt. The balance has exceeded $1.6 trillion. And recent delinquency numbers are extraordinarily high. That is not just a youth problem. It is a national balance sheet problem because debt of that magnitude does not simply reduce spending power for the individual borrower. It changes household formation, fertility decisions, home buying, entrepreneurship, geographic mobility, and the willingness to take career risk. A person with heavy student debt behaves differently from a person without it. He may still succeed, but he begins the race with a different weight strapped to him. When millions do that at once, the macro story changes. This is why I get impatient with shallow optimism. People point to unemployment and inflation prints as though the economy should be judged only by what can be neatly summarized in a briefing note. I prefer behavior. If the economy is so healthy, why are hardship withdrawals hitting records? If the consumer is so strong, why is credit card debt at records and delinquency worsening? If the labor market is so wonderful, why are more retirees going back to work for financial reasons? If inflation is so tame, why does daily life still feel expensive enough that families keep resorting to debt, withdrawals, and postponement? These are not rhetorical questions, they are the adult questions. And adult questions often reveal that a statistic can be technically true and practically incomplete at the same time. The material you shared even points directly at this gap. Official narratives talk about low unemployment, low inflation, and wage growth outpacing prices, but the same material shows slowing wage growth, rising unemployment, and worsening delinquency pressure. That is exactly why I distrust any economic story that is too tidy. A country is not healthy because one line on a chart still looks respectable. A country is healthier when the typical household can absorb ordinary life without repeatedly converting the future into cash for the present. That is the measure I care about. And by that measure, the American consumer looks stretched. Now, let me say something that is often unpopular because it sounds harsher than people want. A lot of personal financial suffering is not caused by stupidity. It is caused by structure. That distinction matters because if you misdiagnose the pain, you prescribe the wrong cure. If you think the average household is simply reckless, then your answer will be moralizing, spend less, try harder, be more responsible. Those sentences are sometimes useful, but they become insulting if the underlying problem is that wages have not kept pace with the true cost structure of modern life in the way the public has been told. The source material makes precisely that argument. That lived inflation feels worse than the clean official narrative suggests, and that wage growth is not truly outrunning the cost of survival in a way households can feel. Whether one accepts every word of that claim or not, the household behavior lines up with some version of it. People do not raid retirement accounts in records because they are celebrating prosperity. They do not return from retirement in records because they are bored in some great national abundance. They do not carry record card balances at punishing rates because modern life feels financially easy. They do these things because the spread between what comes in and what life demands has become too thin. That spread is the real battleground. I talk about spreads in markets all the time. A business with strong spread between its cost of capital and its return on capital is a wonderful thing. A household lives by the same logic. If its income meaningfully exceeds its fixed costs, taxes, debt service, and core obligations, then it has room to build assets. If that spread narrows too much, the household begins liquidating the future. That liquidation can look respectable for a while. Skip a contribution here, carry a balance there, take a hardship withdrawal, return to work, delay a repair, push a bill. Then one day the person looks up and realizes he has been surviving, not building. That is a heartbreaking discovery because it often arrives after years of outward effort. This is also why I care so much about inflation, and not in the cartoon way people talk about it. Inflation is not merely prices rising. Inflation is the quiet destruction of room. A family may still buy groceries, it may still pay the mortgage, it may still keep the lights on, but the margin that once existed around those things gets eaten. That eaten margin is what people really feel. The official rate can be 2 point something. Fine. But if the categories that dominate household emotion, shelter, food, insurance, medical care, education, repairs do not feel like 2 point something, then the household will not experience the economy as healthy, no matter how calm the briefing note sounds. That is why lived inflation and reported inflation so often feel like they belong to different countries. The country with the report is one place. The country with the grocery receipt is another. I do not think this tension will be solved by pretending the public is too emotional to understand economics. The public understands arithmetic perfectly well when it appears in monthly life. What the public often lacks is a clean explanation of how those pressures are formed. Now, the material you shared places a great deal of blame on money creation and central banking. I am not interested in simplistic villain stories, but I also do not dismiss the point lightly. When governments spend beyond discipline and central banks support financial conditions in ways that encourage excess money creation, debt expansion, and asset inflation, the eventual cost does not remain safely abstract. It lands in purchasing power, it lands in housing, it lands in healthcare, it lands in everyday life. And because the transmission is indirect, the political pain gets diffused while the household pain accumulates. That is one reason the public often feels lied to. It hears that the economy is strong while its own life feels tighter. Both statements may carry partial truths, but the one that gets lived will always matter more. This is also why I think people underestimate the danger of the current moment. They say unemployment is still historically low. That is true enough, but if households are already behaving like this while unemployment is still relatively low, what happens if unemployment rises more meaningfully? What happens if wage growth softens further? What happens if student loan pressure keeps worsening? What happens if credit card rates remain elevated and banks become stricter? What happens if the temporary relief from a larger tax refund disappears and the underlying structural imbalance remains? The source material itself points out that larger refunds are acting as a temporary lifeline, but temporary lifelines by definition run out. That is the key word, temporary. The modern American household has become too dependent on temporary relief and not dependent enough on true structural strength. Refunds, promotions, refinancing, a better month, an extra shift, one more side hustle, one more bonus, one more favorable policy tweak. That is not the architecture of calm. It is a sequence of small rescues. A good financial life cannot be built on repeated rescue. It must be built on margin. So what does this mean in practical terms? It means a great many households need to stop interpreting their struggle as purely personal failure. That is not because they are blameless in every case. It is because shame is often poor instruction. If a person thinks the whole problem is his own moral weakness, he will keep trying to solve a structural problem with motivational slogans that never works for long. The right sequence is different. First, stop the bleeding, kill the ugliest debt. Not all debt, the ugliest debt. The 20% credit card debt is not a side issue. It is the enemy at the gate. Second, rebuild liquidity. A household with no cash buffer has no financial dignity because every surprise becomes a negotiation with panic. Third, restore retirement contributions if they have been raided or paused, because the future cannot survive repeated theft from the present without eventually demanding a brutal price. Fourth, lower fixed cost fragility. Where possible, I have seen too many families living in structures that require everything to go right in order to survive. That is not resilience. That is choreography. And life does not respect choreography for very long. Fifth, stop treating the labor market as a permanent source of rescue. I do not mean stop working. I mean stop assuming that one more year, one more promotion, one more side job, or one more delayed retirement will always be there to save a weak balance sheet. At some point, a household has to convert effort into assets. Otherwise, effort just gets consumed by the month. That is what I want people to understand most. The purpose of labor is not merely to survive the present. It is to build assets that will reduce future dependence on labor. Once that loop breaks, the person is trapped. And the source material you gave me is really a story about that trap. The trap of raiding the future to survive the present. The trap of returning to work because retirement has become too thin. The trap of funding daily life on cards priced like punishment. The trap of believing the official language while the household ledger tells a different story. If I sound severe, It is because I dislike preventable traps. I do not think the American consumer is weak in the moral sense. I think the American consumer is squeezed, and squeezed people begin doing things that look irrational from a distance, but make perfect sense from up close. That is why data matters. Not because it gives us the pleasure of sounding informed, because it tells us where behavior is breaking first, and behavior is breaking. That much is already clear. The public does not need another soothing voice telling it that all is well, because one macro print still looks respectable. It needs adult honesty. Adult honesty says that when record numbers of people are tapping retirement money, when retirees are returning to work in growing numbers for financial reasons, when credit card debt and delinquency are rising, when student loan stress is exploding, and when wage and employment trends are deteriorating in the wrong direction, then the household sector is not healthy in the way healthy sectors are supposed to feel. That does not mean despair. Despair is useless. It means seriousness. It means tightening structures before the next round of pressure arrives. It means understanding that official reassurance is not the same thing as household stability, and it means making room, because room is what keeps trouble from becoming collapse. If I had to summarize the whole matter in one final idea, it would be this: the American consumer is still spending, yes, but a rising share of that spending is being defended by things that should not be asked to defend it. For long retirement savings, credit cards, late life labor, debt extensions, temporary relief. That is not strength. That is the sound of a system borrowing against tomorrow, because today already costs too much. Sooner or later, tomorrow sends the bill. I would rather households prepare before it arrives.